As much as we love Roth conversions for tax planning reasons, they're not the best fit for everybody every single year, and they can get you into trouble. Years ago, Roth conversions used to be reversible, meaning that if you proceeded when you shouldn't have or you made a mistake, you could walk back the transaction later in the year. That's no longer the case. So we need to be absolutely sure that before you hit the trigger on any kind of conversion, you know what you're getting yourself into. In this video, we'll share 3 profiles, 3 examples where you do not want to convert assets from a traditional account like an IRA or a 401k to a Roth account. The first reason that we might not want to proceed with a Roth IRA conversion is if we don't have cash outside the retirement accounts to pay the tax on the conversion. So here's what I mean. Anytime we proceed with a conversion, we take money in a deferred account, whether it be an IRA or a 401k, we move it to a Roth account. 100% of what makes its way out of the IRA is a taxable event. You have to pay tax on that amount in that year. So let's make it a simple example. Let's say that we have $10,000 that we're converting from a traditional IRA to a Roth IRA. $10,000 comes out of the IRA. That's a taxable event. If we assume you're in the 22% marginal bracket, and we'll ignore state income taxes, either we ignore them or you live in a state that doesn't have them in the first place, that means that you're going to owe $2,200 of tax on this transaction. 10,000 times 22%. Well, one option to pay that tax is to instruct your broker to withhold from the transaction on your behalf, meaning that $10,000 comes out of the IRA, 22% of that, or 2,200 bucks, gets sent directly to the IRS toward your taxes for the year. The other $7,800 left after the withholding is what makes its way into the Roth IRA. That is one option. The problem with that is the way to ring the bell on retirement accounts, whether they're in your traditional tax-deferred IRA or your Roth account that will be tax-free from that point forward, is to keep as much in there as you can and allow the investments inside the account to keep growing and compounding for your benefit. And in that scenario, yeah, you didn't have to pay tax out of pocket on the transaction, but you went from $10,000 in the account to $7,800 in a retirement account. And that kind of shoots yourself in the foot. Yes, it might still be beneficial, but you're almost always better off paying that $2,200 of tax out of pocket by cutting a check to the IRS or paying it from another source. So if you're in a position where you want to do some kind of conversion, but you don't have the cash to pay the tax and you're wondering if you should just withhold from the transaction before proceeding, I'd say it might not be a good fit. You should probably think twice about whether you want to proceed. The second circumstance where we might not want to proceed with a Roth conversion is if we're in a high tax bracket. A lot of people fall in love with the idea of Roth conversions. They have a lot of benefits, but the point of tax deferred versus tax exempt accounts, the main difference is, do we pay tax now or do we pay tax later? In your traditional IRAs or traditional 401ks, you're predominantly putting money in that you don't pay tax on now. The money goes into the account and then it grows from investments and compounds to your benefit, and you don't pay tax on any of that growth. You pay tax on 100% of what comes out of the account later. And if you don't, even if you don't want to take money out of the account in your 70s and 80s, the government's going to force you to, because they've been waiting to tax you on that money for a long time. They don't let you keep it in there forever. Tax-exempt Roth accounts are the exact opposite of that. We pay tax now on the money that goes into the account, but then it grows and compounds, and when you take it out later, you don't pay tax later as long as it's a qualified distribution, which in most cases it is. So a lot of people fall in love with this idea of Roth conversions, but we have the latitude to either keep the money in the deferred account and not pay tax on it until we take it out in the future, or take the money and convert it to the Roth account and pay tax now. And for a lot of people who are in the peak earnings years of their careers, and maybe your late 40s, 50s for kind of the traditional trajectory, Roth conversions might not be the best idea at the moment, because you're in your peak earnings years. You might be in a higher bracket, whereas after you stop working and transition into retirement, you might be in a lower bracket, right? The fact pattern and circumstances are different for everybody, but the point is, if you're in a high bracket now, it's probably not the right time to convert tax-deferred money to a Roth. If you're in a high bracket, you want to kick that tax can down the road, find as many deductions as you can. It's not until you fall into the lower tax brackets that it might be beneficial to proceed with a conversion. Third example of when not to proceed with a Roth IRA conversion is if you need the money sometime relatively soon and you've not satisfied the 5-year Roth IRA rule. Now, I will try to explain the Roth IRA 5-year rules. There are 2 of them that are relevant here without screwing anything up. Basically, the first 5-year rule is that you have to have a Roth IRA with money in it for 5 years before you can take out earnings tax-free. So if you have had a Roth IRA for more than 5 years that's had money in it and you're older than 59 and a half, this is not an issue for you. If you are opening a Roth IRA for the first time and you're making a contribution, not a conversion, okay, let's say you deposit $7,000, which is the maximum contribution for people under 50 in this year in 2025, then you can withdraw that's up to $7,000 tax and penalty free whenever you need it. But if you're under 59 and a half and you take out the earnings prior to 5 years, so let's say that you open a Roth IRA, you deposit $7,000 in there, and then it grows to $10,000 over the next 3 years. Well, if you take the full $10,000 out and you're not 59 and a half, because you've not had a Roth IRA with money in it for at least 5 years, the first $7,000 that you put in, that comes out tax and penalty free, but the $3,000 of earnings you pay tax on and a 10% penalty because it's not considered a qualified distribution. Once you turn 59 and a half, let's say that you're 60, you pull the full $10,000 out of there. If you've had the account open for 5 years, you pull the full 10,000 out. That means that 7,000 that comes out is principal or your contributions, and $3,000 comes out tax and penalty free. It comes out penalty free because you're older than 59 and a half. It comes out tax free because you've had a Roth IRA with money in it for at least 5 years. If you pull the money out 59 and a half or older, but you haven't had a Roth IRA with money in it for at least 5 years, then the 7,000 comes out tax and penalty free. The $3,000 of growth, that comes out penalty free, but you still pay income tax on the $3,000 of growth because you haven't met that 5-year requirement yet. One more note is that it doesn't have to be, you don't have to have that account, that specific account at that brokerage firm with that account number open for 5 years. It could be any Roth IRA at any brokerage firm as long as it has money in it and you've had it for at least 5 years. That checks the box. The second 5-year rule we need to be aware of has to do with conversions. Basically, anytime you do a Roth IRA conversion, there's a clock that starts on January 1 of the year that that transaction occurred. Even if you do a conversion in August, the clock starts January 1st. And then it ends December 31st, exactly 5 years later. Well, let's use our example. Let's say you do a Roth conversion with $10,000 from your traditional IRA, you move it to your Roth. If you take the money out of the Roth IRA before 5 years have occurred, you could be subject to some penalties. Let's say that you do that and you're not 59 and a half yet. So you have $10,000 that went from your traditional IRA to your Roth IRA, but you're only 55 years old. Well, the entire amount that was converted would be subject to the 10% early withdrawal penalty, and any growth that occurred in the Roth would be subject to income taxes. Now, if you wait until you're after 59 and a half, then you don't have that problem. You don't have that 10% early withdrawal penalty, but the first 5-year contribution rule could apply. So remember that these are conversions we're talking about. If you haven't met that first rule that we talked about a minute ago, even though you're after 59 and a half, because you haven't had a Roth IRA for at least 5 years, you could be subject to taxation on the entire amount, the growth that came out of the account. So be aware of all this stuff before you proceed, because it bites a lot of people in the rear end. And the rule here is, if you think you're going to need the money here in the next 5 years or so, you might not want to convert it. One other note on this is each conversion has its own 5-year window. So if you do two conversions this year, once in March and once in August, they'll be lumped together in the same 5-year window. But if you do one conversion this year and another conversion next year, they'll both have their own 5-year windows that you probably want to be aware of. Sometimes once I get rolling on Roth conversions and so forth, it's kind of hard to stop. So in this video, we're going to throw in a bonus fourth reason you might not want to proceed with a conversion. And that's if your plan is to give most of your traditional IRAs or 401ks to charity over time. If that's your plan, if you have an IRA, 401k, 403b, SEP IRA, simple IRA, if charitable contributions are part of your plan, then you should definitely not convert that money to a Roth account. When you convert the money to a Roth account, you're paying tax on 100% of what makes its way into the Roth account. But if you give the money to charity, that's either a deductible, itemized, it's an itemized deduction on your tax return, and even better, you can structure it as a qualified charitable distribution to where you don't pay tax on the distribution at all. So it's a really, really tax inefficient way to handle your charitable giving. Don't take it from a deferred account, convert it to a Roth, and then give it to charity. Keep it in the tax deferred account. Don't pay tax on it at all if the plan is to give it to charity anyway. That's it for today's video. I hope you enjoyed it. The moral of the story here is measure twice and cut once when it comes to Roth conversions, because they're not a transaction you can walk back later. These are just a few examples of circumstances where you probably don't want to proceed with a conversion. Just make sure you know what you're doing before you walk yourself into this. Hey everybody, real quick, if you're someone who's saving for retirement and you're wondering how much you need saved up in order to retire, there's a whole bunch of different rules of thumb that you can use. Unfortunately, none of them are very specific or very good for our own financial planning purposes. If you're there wondering how much you need to retire, we built a 2-minute quiz you can fill out anonymously, and we'll email you the result of some rough numbers you might want to consider. As always, it's not advice, but maybe it's a point in the right direction. Click the link below here in the description if you're interested. Again, it won't take you any more than 2 minutes.